Hey, and welcome to Granite Funding Group's closing cost worksheet. As you'll see, this worksheet will cover all of the closing costs associated with a mortgage loan, and it will do it in a much more concise fashion than the current good faith estimate. The good faith estimate is in your package. You're receiving this video because you'll get the entire package and you'll have this closing cost worksheet on top. We want to give you a little guidebook, really a visual one, of how to walk through it and explain what everything is so you understand what kind of loan you're getting. So we'll start at the top. We've got your customer information, we've got the property address, sales price, the base loan amount, and then the loan amount with mortgage insurance. This is an FHA loan. Mortgage insurance is financed, meaning it goes on top of your loan, but is part of the loan, so you don't have to come out of pocket for it. And that total loan amount of $212,087 in this case is with the mortgage insurance premium. We've also got your interest rate listed on there as 5.5%. That's the interest rate that would be paid. 6.448, and remember this is Joe Customer's interest rate. You may have a different one. 6.448 is the annual percentage rate. Now, quick primer on annual percentage rate. That is the lifetime yield to the bank. A little bit of a confusing formula, but it started back in the days of the early 80s when people were charging 6-7 points for loans and then telling the borrower that they had a nice low rate without realizing that they were ending up paying a lot more in interest to the bank over the life of the loan. So origination charges, processing, most of title and escrow, any impound account, all those things are part of your annual percentage rate along with mortgage insurance. So on an FHA loan, you'll see that the annual percentage rate is a bit higher than the contract rate, but the contract rate, in this case 5.5%, is truly what your schedule monthly payments will be based on. So let's focus on box one here. We've got our origination charge. We've got our processing fee payable directly to our processor. Catherine Navarez does a great job, and you'll talk to her throughout this process. We've got document preparation. We charge that for the storage and maintenance of your loan and file, which has to be kept for 7 years. And then we have a lender fee, which is payable to the bank, directly to the bank for the doc drawers, the underwriters, the funders, everyone who works on the back end of the loan process. That is how they actually get rewarded and paid for their efforts. So down here we have the total of our origination charge. That's everything that's paid directly to us. Required services that we select is going to encompass various items that are third party, but Granite Funding Group is deciding where those go. Number one is the appraisal. A lot of times you'll pay that outside of closing, but it is a closing cost, so we need to show it to you in there. Doesn't mean you're going to come in with the money at the end, but you may, depending on how we arrange it. Credit report, that's a ballpark. Once again, this is Joe Customer's loan, and in this case it was $19.50 worth of credit pulls, and then the upfront mortgage insurance. And you'll see as we wrap this form up how that accommodates in the financing portion. It goes as a cost, but then it's offset as a credit because it is financed. I want to show you all these title fees right here. These are a sample. This is actually from a real life loan. You may have some different ones on yours, but this is going to be all verified, or should be by the time you get this. We have to certify all third-party title fees, so we do our best effort within 72 hours of a borrower getting into contract, say, of reaching out to escrow, whatever company is doing your escrow, saying, hey, we need all of your fees validated so we can get an accurate estimate to our borrowers. Owner's title insurance, not a borrower cost, but we're still required to show you the cost of it. We've got recording. That is when your loan actually gets recorded. They'll record your deed with the county. And then we have transfer taxes. That's what the county and city charge to transfer the property. Escrow account, that is if you have an impound account, and FHA loans require one. An escrow account actually will take your monthly payment, and as part of your monthly payment, collect a little bit extra, or, you might sometimes think a lot extra, but anyway, extra, to accommodate your homeowner's insurance and any property taxes that you have. Now that's, in this case, we've collected 3 months of each, and you'll pay a year of your hazard insurance up front. You'll pay 1 year up front, then 3 months into your escrow account. And the reason for that is, same with the property taxes, you seed the escrow account. It's a little bit of lender protection, so basically if you never made a payment on this mortgage loan, they would still be able to pay your taxes and your hazard insurance the next time they came due. So down here we see your hazard insurance, $729.60. Once again, this is an example, but what this shows is that you paid a year up front, and then over here we collected 3 months to go into your escrow account. So now box B, if you remember, box A at the top was our origination. Box B is all other settlement charges, and then A and B is your total settlement charges. Now remember, this includes that mortgage insurance premium. Back to the top here of our document, and we have your estimated funds needed to close. This is critical and really what you want to be seeing. In this case, we have your total estimated settlement charges. The mortgage insurance, as we said, is financed, so in brackets that's a credit. Cash deposit, in this case, we had a $2,000 cash deposit, and then in this case, closing costs were paid by seller to the tune of $5,500. Total down payment was $7,560. That's the required down payment on a loan amount or a purchase of that size. In this case, FHA, 3.5% was the minimum down. And total cash needed to close based on all of this was $8,908.73. Down below that, if you want to get specific about what you're going to be up against every single month, we have put a nice little box here, which is your first lien, principal, and interest. Second lien, if there was any, would go here. Your homeowner's insurance, that's your monthly. Your property taxes monthly, and your mortgage insurance monthly. So it comes out to your total monthly payment. This is what you can expect to pay monthly for this mortgage loan. We put this together because we didn't feel like the new 2010 good faith estimate did a great job. It's not a bad document, but we didn't think it did a great job, which is what we want, of explaining to our customer how their costs are broken down, how their payment's broken down, and how the transaction will close, what they're going to be responsible for at the end. So we hope that you found this valuable, and we hope that this explained this document. I know you've got a stack of paper in front of you. So the more we can do to explain the documents, the better off you're going to be. If you have any questions, contact your loan officer here at the office, and they can definitely get them handled for you. Thanks for watching, and have a great day.